Welcome back to Navigating Abundant Retirement. I'm Carol Dewey, and today we're tackling a subject that has been front and center in so many conversations lately, the difference between recording history and actually planning for the future when it comes to taxes. Last week, we asked the big question: when was the last time your CPA called with an idea to save you money? The truth is, for most business owners and high net worth individuals, the answer is never. Not because your CPA doesn't care, but because their role is designed to record what already happened. That's important work, but it's not enough if you're serious about keeping more of your wealth. Today, I'm going to walk you through what proactive tax planning really looks like. We'll explore the strategies most CPAs never bring up, why the next 18 months may be the most critical planning window of your lifetime, and share some real-world stories of clients who saved hundreds of thousands of dollars simply by changing their approach. So grab your notepad. This is going to be one of the most important financial conversations you'll hear this year. Let's start with the basics. A CPA's job is to record history. They're historians. They take all of your income, expenses, deductions, and credits and prepare your tax return to make sure it's filed correctly with the IRS. They're essential. But by the time they're running the numbers, the year is already over. That's why I call it recording history. The damage or the opportunity has already passed. On the other hand, a strategist is more like an architect. They're not just recording history. They're helping you design the future. They're asking questions like, what will your tax rate look like 3 years from now? What happens if you sell your business? How can we minimize taxes on your retirement income streams? Is there a way to redirect your charitable giving to double as a tax shield? Here's a real story. A business owner sold a piece of property without any advanced planning. Their CPA did everything right on the tax return, but it didn't stop them from owing six figures in the capital gains tax. Compare that with another client who set up a charitable remainder trust before selling. They not only reduced their taxes dramatically, but also created a lifetime income stream for retirement. That's the difference between recording history and planning ahead. Now let's zoom out to the bigger picture. We are in one of the most important tax planning windows we've seen in decades, and here's why. The U.S. deficit and ongoing government spending make future tax increases more likely, not less. Inflation and rising interest rates are putting added pressure on both individuals and businesses. And for retirees, required minimum distributions and IRMAA surcharges on Medicare can quietly drain your nest egg if you don't plan ahead. For business owners, it's even more urgent. If you're thinking about selling your company, the difference between planning your exit now versus just waiting until the sale can mean millions of dollars in after-tax proceeds. And for the high net worth families, waiting until tax time is just simply too late. By the time your CPA is preparing your return, the opportunities to shift income, make strategic contributions, or restructure your holdings have already passed. This is why proactive planning isn't optional anymore. It's the only way to protect your wealth from being siphoned off by the IRS. Then we have the new tax bill that's actually a stimulus plan. What looks like an extension of the 2017 tax cuts is, in fact, a wide-reaching stimulus effort. The extended tax relief creates a longer runway for planning. So with the One Big Beautiful Bill, key provisions of the 2017 Tax Cuts and Jobs Act have been extended, meaning business owners and investors now have a longer window to leverage favorable rates and deductions. But just because the window is open doesn't mean you should wait. Acting early locks in the biggest benefits. Interest deduction limits have been expanded. R&D deductions have been re-energized. However, the defense, infrastructure, and border budgets have been ballooned. This is where the bill becomes personal for you. If you own a mid-sized business or are sitting on a concentrated position in growth-oriented stocks, this bill just handed you an incentive to invest, expand, and plan smarter. But the real value isn't in just knowing this. It's in acting on it while the window is still open. So what does proactive planning actually look like? Let's highlight a few of the strategies that rarely make it into a traditional CPA conversation. There's Roth conversions with tax bracket management. Converting portions of your IRA to a Roth in lower tax years can reduce lifetime taxes and eliminate RMDs later. But timing is everything. You don't want to push yourself into a higher bracket. We have a proprietary strategy we call the Roth Accelerator for tax-free income for those who have a minimum of $400,000 in qualified funds. Then we have charitable strategies like donor-advised funds and charitable remainder trusts can allow you to give generously and cut your tax bill. In some cases, you can turn charitable contributions into lifetime income streams. And of course, there's cost segregation and bonus depreciation. Real estate investors can accelerate depreciation deductions, creating large paper losses that offset active income. And then we've got advanced retirement plans. Cash balance plans or 401h medical accounts allow business owners to put away much larger sums than traditional 401ks while receiving tax deductions now. And of course, entity structuring and income shifting. Are you using the right entity? Sometimes moving from an S Corp to a C Corp or vice versa can save substantial taxes depending on your goals. And we have captive insurance companies. For larger businesses, captives can convert deductible premiums into a vehicle for wealth accumulation while providing real risk management. These strategies aren't exotic, they're established, legal, and proven. But they require foresight, coordination, and expertise beyond what most CPAs offer. The real value isn't the tool itself, it's knowing which tool applies to your situation and when. And it's something I like to refer to as timing, combining, and sequencing. Let me share a couple of stories from my own practice. Case study number 1 was a business sale. A client was preparing to sell a business valued at around $12 million. Their CPA was excellent at the compliance part, but hadn't raised the idea of restructuring ownership in advance. By bringing in proactive planning, we were able to restructure the sale, incorporate charitable strategies, and reduce their tax liability by over $1 million. In case study example number 2, it's a high-income professional. Another client, a physician, was earning close to $900,000 annually. Their CPA was focused on deductions, but not long-term strategy. Through Roth conversions, a cash balance plan, and a donor-advised fund, we cut their effective tax rate almost in half over a 10-year window. These examples illustrate the point. It's not that your CPA is doing anything wrong. It's that they're doing their job, recording history. But unless someone on your team is planning strategically, you're leaving money on the table. Before the One Big Beautiful Bill, many of the 2017 Tax Cuts and Jobs Act provisions were set to sunset at the end of 2025. That meant higher personal tax rates, a lower estate tax exemption, and limits on business deductions were looming. With the One Big Beautiful Bill signed into law, much of that has been extended. For business owners and high net worth families, this creates a longer runway. You now have more time to leverage today's historically favorable tax environment. Low corporate rates, expanded R&D deductions, and higher estate tax exemptions. But here's the trap. More time doesn't mean you should wait. Think of it like running a business. If you wait until the end of the runway to throttle up, you may not have enough speed to get off the ground. Smart planning means using the extension period proactively. Consider estate strategies. Lock in today's higher exemption amounts before politics shift again. Business investments. Accelerate R&D and equipment purchases while deductions remain favorable. Tax diversification. Shift income streams into more tax-efficient vehicles while rates are still known. For our clients, business owners, executives, and high net worth families, this isn't about panic. It's about positioning. Those who move first will have more options and greater control. Those who wait may find the political winds shift and the door closes faster than expected. So where does that leave you? With an opportunity and a choice. The One Big Beautiful Bill has bought time. It extended many provisions that were scheduled to vanish in 2025. That gives business owners, high-income professionals, and families with significant wealth a longer runway. But as any pilot would tell you, runways aren't infinite. If you wait too long to throttle up, you may run out of space before you ever take off. Smart tax planning isn't about reacting at the last minute. It's about using the extended window to make intentional moves now, while the wind is at your back. That's what we're here to do. Help you turn this extra time into extra opportunity so you don't just preserve your wealth, you position it to grow and endure. And as I often say, the smartest financial decision is usually the one you make today. Thank you for joining today's session. The One Big Beautiful Bill has given us all more time, but not unlimited time. The runway has been extended, and the question is whether you'll use it to gain momentum or wait until it's too late. If you're ready to take action, schedule your complimentary lifestyle and legacy assessment today. Let's make sure you're not leaving money or opportunity on the table. This is Carol Dewey with Perpetual Wealth Financial. Stay informed, stay empowered, and remember, we help navigate the financial seas so you can get on with living, and I will see you again next week.